And then I started thinking, well, is this really how I want to do things? Do I want to obsess about macro and try to get out of things before they completely collapse? And I said, well, if I'm going to continue to pick stocks, I need to find basically businesses I'm more comfortable holding for a longer period of time and through recessions, things that can actually perform well throughout an entire economic cycle.
Hey, everybody. Welcome to the Millennial Investing Podcast. I'm your host today, Patrick Donnelly, and joining me in today's studio is the Value Stock Geek. BSG, welcome to the show.
Hi, thanks for having me.
I am happy to have you on here. I've been following you for quite a while, it seems like, on Twitter. I love your content. I've learned a lot from you. So I just want to dive into your history. I want to start off with your early years and specifically, and just kind of hear about your journey into value investing, like how you got turned onto it, the books, the teachers that influenced you, things like that.
Sure. So, the main influence for me has been Ben Graham. I think a lot of advanced investors tend to roll their eyes at some of the Ben Graham concepts because they've become cliches, but I think everything really goes back to that. And, discovering Ben Graham was a major moment for me. I got interested in investing in the late 1990s during the internet bubble. And the discovery of Ben Graham was a major revelation for me. So, it was in 2000 when I first came across The Intelligent Investor. I was 18 at my graduation party, and a family friend said, "Oh, if you're interested in investing, this is the book you should read." And then I checked it out and I kind of realized, wow, everything that's going on right now is pretty insane. And it was a major wake-up call for me. And then just seeing the concepts of margin of safety, the idea of thinking of a value and the price as two separate things, those were all kind of major wake-up calls for me. And then that led me down the whole path of learning about Warren Buffett and value investing and everything else.
So yeah, I wanted to hear a little bit about, you're 18 years old. That's a pretty young age to get started in investing. Did you have a family member, like a father or an uncle? You mentioned a family friend, but how did you first get started? You said it was like the .com era. I presume you started investing prior to getting into value investing. So tell me a little bit about that, like your early years, like at the dinner table, for example, and maybe talking about investing.
Yeah, so my parents are like 401k investors, but they were never picking stocks or anything like that. So it was never something that was discussed around the dinner table. During the internet bubble, even for a high schooler, everything was just kind of in the air. Everybody was talking about the market. Like you would turn on the TV and everything was about that. And then I was always a computer user. So I was on the web, when I was pretty young, like 95 or so. We were on that. So I was very much in the mindset that the internet is going to change the world and, maybe we should invest in this. And then I had a little bit of money and my parents helped me open up a brokerage account to encourage this interest. And I mostly bought internet stocks and I was, very much into the bubble and I didn't know anything about the market. And one of the stocks I owned was Cisco Systems. And all I knew was, hey, it's going up and this is great. And it's benefiting from the internet. And then people kind of heard that, oh, he's really interested in the stock market. And I learned what I could. And I had a family friend who did pick stocks. And he kind of caught wind of that at my graduation party. And then he said, hey, you should check out The Intelligent Investor. And I had never heard of it before. And I said, okay, I'll check that out. And I thought it made a ton of sense and it really spoke to me. And then, from there, I went on to read books about Buffett. I read Buffettology. That was a good one from Mary Buffett, who wrote that book talking about some of his methods. And then I started to get into the Buffett letters and reading some other books. So very quickly, I was kind of indoctrinated with value investing. And then as I saw the internet bubble implode throughout college, it really resonated with me. I'm like, oh, they were right about everything. It definitely makes sense. The people who looked at stocks as ownership shares of businesses did a lot better than people who were just kind of playing this gambling video game that was happening in the late 90s.
Yeah. So those early investments, did you end up losing money on them? The Cisco's and the whatever other internet companies you ended up buying?
So by 2000, I was all in on Cisco Systems, which was, I had my little brokerage account in Cisco Systems. And then I actually read The Intelligent Investor and that prompted me to sell Cisco Systems.
So you got out in time?
I got out. It was a few months after the fact. This was like June 2000, May 2000, something like that. So it had already been down quite a bit. But I missed a bulk of the decline. And with that said, it wasn't much money anyway. So it's not like I saved a fortune by getting out of Cisco one time. It's like I saved a couple summers of lawn mowing money.
It sounds like it's a great lesson, though. I mean, I think early losses can be a great lesson to investors. Having a big win as your first investment can be, sometimes that can be, you think like that's to be expected, and that's definitely not the case. But I wanted to hear a little bit about like getting out of college. I understand you had a little bit of like debt. I wanted to talk about that, kind of like how you worked your way out of debt, started saving. I know you're into the FIRE movement, which we'll get into. So talk to me a little bit about just graduating from college and having a little bit of debt and getting out of it.
Sure. So I struggled a lot getting out of college. I had some financial debt. A lot of that was related to just kind of a toxic relationship with life and money. And a big part of that was drinking. Right now, I haven't had a drink since 2008. I've been sober the whole time. That was a major part of cleaning up my finances and things like that. I got a good job out of school, but I had a bad attitude about it. I was like, well, I have a good job, so I need to go get a cool car. And I need to go out tonight. And well, I'll probably get a raise next year and get a good bonus this year, so that'll take care of that. And eventually that just led me to one day I realized, oh my God, I have this mountain of debt that I need to get out under. So at that point, I discovered Dave Ramsey. That was kind of my introduction. So I went from learning about the market, and I majored in finance in college. And then it was, well, I need to learn about personal finance, because clearly all of that head knowledge isn't really helping me right now. And I think the key thing that he gets is, he's wrong about a lot of things, but I think the core thing he gets is that personal finance is all about behavior. It's not really about all that head knowledge and all of that math. And I use the debt snowball, which I admit doesn't make any mathematical sense, but he's right in terms of the way that it gives you kind of momentum going forward. You list your debts, smallest to largest, and then you attack them one at a time. And as you eliminate them, you develop psychological momentum and you feel like, oh, I'm really making progress towards this. And I did extreme things, like he's talking about like the rice and beans kind of thing, like dramatically cutting your expenses. I lived in like an unfinished basement for cheap rent. I lived on like $25 worth of food expenses a week. So I went all out, and then I was out of debt within a couple years. And then I kept kind of that mentality going for a while, and that helped me really save up when I started to have more substantial sums of money where I could get much more serious about this hobby I had when I was younger. And that's what led me to investing. Once I got all the debt cleaned up and I had some money and then I started investing, that's kind of when my second journey began.
Right. Were you into, it sounds like you were pretty extreme in your cutting your costs. Were you into like Mr. Money Mustache, or there was another book called Early Retirement Extreme or something like that years ago that's like kind of popular in the FIRE movement? Were any of those influences for you?
They weren't around yet, so later on I discovered them. But for me, like my late 20s was really about getting out of debt. And then by the time I was 30, this was like 2012, that's when I started to get more into investing all over again. Like I wanted to reawaken that hobby. And then around that time, I did discover Mr. Money Mustache. And I have read Early Retirement Extreme. So that's a wild book. That takes it too far, I think. I
do too, yeah. I think that guy lives on like $7,000 or $8,000 a year, or something like that, is what I want to say. And it's an older book, but still pretty extreme.
Yeah, and for him, for his perspective, to defend him a little bit, for him, it's not just about like saving money and being financially independent. For him, it's like a moral choice about the environment and that type of thing, and then living a life that more reflects his values. That said, I can't live like that. So I don't do that. But I discovered the FIRE movement, in my 30s. And that's when I started really pursuing that aggressively. I wish I had gotten my act together much earlier, and then, and I'd be further along in that journey. But I discovered it, and I think they make a lot of sense.
So you got yourself out of debt. You've been influenced by Ben Graham and Warren Buffett and these value investors. When you started investing, did you continue to apply value investing principles, or did you kind of veer off at all? Or I want to hear about that once you were out of debt and started your like investing journey in earnest.
Yeah. So at that point, I decided to really start buying stocks again, buying individual stocks. And at that point, I was more, I'd say I did more of the Warren Buffett kind of thing. And I actually started there. And then I went more towards Ben Graham after that. Like I started buying a lot of individual stocks and I would have a pretty concentrated portfolio. And then I started to realize, well, this has some hits, this has some misses. Some things are working pretty well, some things aren't. And I said, I really need to get better at this. So that really led me down to going deep into quantitative value investing. And that's when I first came across Quantitative Value by Wes Gray and Toby Carlisle. And then I read Deep Value. And then I started to apply, and Joel Greenblatt, and I started to move towards more of a quantitative value kind of strategy. And I really started doing that around, I'd say, probably 2013, 2014, something around that. 2014 sounds about right. And that's when I started applying more of that. And I had developed my own approach. At the same time, I also started to do a lot of my own back testing. Like I would use, different screeners to develop my own strategies, back testing them. And what I ultimately decided upon was this quantitative strategy based on Ben Graham's Simple Way methodology, where you would buy stocks basically with low PEs and low debt to equity ratios, and you would form 20 stock portfolios based on that. And then I went in and I added a lot of things to that, like enterprise multiples, like Toby Carlisle suggests. I looked for earnings consistency. And then I also started to dig into the companies a little bit and start to do some qualitative work to weed things out of there. But for the most part, it was kind of like a deep value quantitative approach. And then around 2016, I decided I'd like to start interacting with some other people that are out there, whoever is out there in the internet, out there in the value investing community, who maybe I could learn from and interact with. And then I started a little blog where I tracked my personal portfolio. And that's kind of how this whole thing got started. It was just a little blog where I was posting about my personal portfolio. And then that's when I really started to get on Twitter and move on from there.
So you mentioned Joel Greenblatt, were you into his, I forget what it's called, like the magic formula? Were you applying it sounds like to some degree you were applying some of his principles?
Yeah, that was the first quantitative oriented value investing book I ever read, was The Little Book That Beats the Market. And then I moved on to Quantitative Value and Deep Value. And I love The Little Book That Beats the Market. And I think it's a great way, high level, to think about investing. But there are serious limitations to the magic formula approach. Toby Carlisle his books are all about how the ROIC metric actually detracts from returns. And I think the reason that is when you mechanically buy stocks with high ROIC, you find a lot, especially if they're in a value kind of bucket, you're finding stocks that are in kind of a temporary cyclical boom, especially if you're only looking at things on a trailing 12-month basis. And you wind up buying a lot of value traps. And ironically, pure value tends to work a lot better than combining value with ROIC.
So when you say ROIC, that's return on invested capital, correct? For our listeners that might not be familiar with that term.
Yes, that's correct. Yeah, and I think, so right now I look for businesses with higher ROIC. My approach has evolved past quantitative oriented. I'm much more qualitative now and in the past few years. But initially, yes, I was trying to mechanically find those. And I think what's missing from that magic formula approach is that Warren Buffett, the idea is, okay, Warren Buffett buys value, but he also buys quality, which you're defining as high ROIC. But the thing that Warren Buffett is looking for is sustainable high ROIC. He's not just mechanically buying stocks that have the highest ROIC in a value bucket. And that's a much more difficult kind of qualitative endeavor. And I don't think that you could really replicate that in a simple screen.
So you mentioned Toby Carlisle. Are there other people in the value investing community that have made a big impact on your current approach?
Yeah, absolutely. So I did more of this quantitative value kind of thing where I'm looking at very depressed value situations. And yeah, there was a lot of that going on in the late 2010s. And then what I found was during COVID, it was pretty terrifying to own, for instance, a bunch of energy companies and mall retailers during COVID. And I had to sell a lot of those. And Fortunately, I avoided like a 60% drawdown by getting out of a lot of those positions around March. But then I didn't get back in on time. And then I started thinking, well, is this really how I want to do things? Do I want to obsess about macro and try to get out of things before they completely collapse? And I said, well, if I'm going to continue to pick stocks, I need to find basically businesses I'm more comfortable holding for a longer period of time and through recessions, things that can actually perform well throughout an entire economic cycle. So that led me into a lot of the work of Pat Dorsey, who's written a lot, who's like the gold standard on moats. That was a huge influence on me. And then I actually went back and I reread the Buffett letters, which I hadn't read since I was in college. And that made a huge impact on me, where I started to realize, oh, well, it started to get me more of back into that Warren Buffett mindset. Another one I read that was very influential was Robert Hagstrom's book, which I thought was very interesting.
Which one was that? The Hagstrom book? Was that
The Warren Buffett Way?
Yeah, that is a really good one. Deep Value. I'm not familiar with the Deep Value book you mentioned. Tell me more about that. Like, what was your takeaway from Deep Value?
Deep Value is a great book because I think a lot of value investors tend to think of it more in terms of like you're buying something with this intrinsic value and you're buying below that intrinsic value. And what that book is really all about is that mean reversion isn't simply mean reversion in price, it's mean reversion in business performance. So the whole idea that he's explaining in that book is that the reason that this works is because there's fundamental mean reversion that's happening there. I don't want to put words in Toby's mouth, but if I were to take away like kind of the key lesson of that book, that's what you're looking for. You're not really looking for this perfect situation where it's at a discount to intrinsic value and that's a fixed amount. You're really trying to get situations where the business has been through some difficulty and then you're trying to catch some mean reversion in the actual fundamental business performance.
I want to talk a little about moats. Was it Pat Dorsey? Is that who you took a lot of your thoughts on moats from?
Yeah, I learned a lot about moats from reading his books. And he has a very good one, the Little Book That Builds Wealth. That's kind of like the Cliff Notes version of a lot of his moats research. And there's a lot to learn from that. And basically what you're really thinking about, I'd say if I were to boil it down to this, is how easily can this business be disrupted? How easily can this business's returns on capital fall? And if there's some attribute to the business, whether it's, it could be network effects is one of them. There could be regulatory things that keeps a business in a strong competitive position. Brands are obviously another source of moat. There's all these little sources of moats. But I think high level, the way to think about it is to just consider how easily can this business be disrupted in 5 or 10 years. And that's really how I think about it. So right now, what I really do is I apply that all those things I learned from quantitative value investing, I'm still using those, but I'm applying them towards a universe of companies that I've pre-selected and that I'm comfortable holding for a longer period of time.
So it sounds like you're doing individual stock selection because you love it. I can tell like you just love the research and learning, but you're also doing this idea of like the weird portfolio, which I want to get into. So tell our listeners what the weird portfolio is. We'll get into like the allocations of it, but tell me just how you came about with that idea and started implementing the weird portfolio.
Yeah, so the weird portfolio is really my take on Harry Browne's permanent portfolio. So I learned about Harry Browne's permanent portfolio. And for those who aren't aware, what the permanent portfolio is, it's a very simple portfolio, 25% stocks, 25% long-term treasuries, 25% gold, 25% cash. When you backtest this strategy, it delivers a decent rate of return. Like you're going to underperform, obviously, 100% stocks, but it still gives you a pretty nice rate of return. And the incredible selling point is just the minimal volatility of it. So for instance, in 2008, this portfolio was only down 2%. So I said, I want my own version of a permanent portfolio, but I want to add some things to it. So I added, I made it a global portfolio. So it's not simply US stocks, it's globally diversified. I got rid of the cash component because I have plenty of cash in, for instance, my emergency fund. And I wanted to have more of a pivot to value, to small cap value, a more systematic approach towards value investing. I didn't want as much exposure to large cap bubbles. So that's kind of the methodology behind that. Now, why I developed that was really my growing frustration with macro. So around 2017, 2018, I started to realize macro was really unpredictable. So going back through my own history, I had some good macro calls, and that gave me the false sense of confidence that I had a knack for predicting macro. Like I told my family in 2007, this real estate thing is a bubble. You should probably underweight stocks right now. And then when 2008 arrived, I thought, oh my God, I did it. Then in 2009, I actually emailed my dad near the bottom of the market. And I'm like, you should go all in because there's Shiller P's at this level. And I think the market's attractively valued. So then I'm like, okay, I've got this nailed. I'm great at macro. But then the rest of the decade unfolded and I thought QE would cause inflation. Never happened. I thought FANG was a bubble. Didn't happen. I thought unemployment, in 2010 would come down faster than it actually did. And over again, I'm learning, I actually suck at this. And then as I started to learn more about macro minds that are out there and I started to research them, I started to realize, well, they're kind of full of crap too. They're always wrong. They never, anytime you actually write down their predictions and then see what actually happened, they're almost always wrong. So I said, I need an approach that for a portion of my money where it is just macro agnostic, where I can really just set up a systematic approach, put this to the side and know that I have some protections for different environments. That was the impetus behind developing the Weird Portfolio. And then finally, I started investing that way in 2018-ish, around then, 2017, for a portion of my money. And then when I saw how wrong I was about COVID, where I thought, for instance, I'm like, well, obviously, all these companies have all of this debt and the economy is shutting down right now. The Buffett metric and the Shiller P are at all-time highs. Obviously, this is the beginning of the end, and this is going to be just like 2008. And then that didn't happen either. So that's when I kind of half believed macro was unpredictable around 2020. And then COVID happened and I'm like, macro was completely unpredictable and I need a process to insulate me from all of this. And the Weird Portfolio was a key part of it. And then with my stock picking, a focus of more on companies that could be held for longer periods of time was another piece of the focus. And the whole thing is to just get away from that kind of macro prognostication.
Right. So how do you break it down with your own portfolio? How do you delineate, or what kind of allocation are you making towards individual stock selection versus what you allocate towards the Weird Portfolio?
So I don't want to get into specific percentages, I'm this percentage weird, I'm this percentage stocks, but basically I've taken my stock money and I've said, hey, I have it in a tax advantage account because with turnover, you want to reduce taxes. ETFs are a lot more tax efficient. So I set that aside and I said, I'm going to buy businesses just because I love it so much. I love researching companies. I love learning about companies. I love trying to figure out how a stock is going to turn around. I love learning about businesses. I didn't want to give that up. And then the rest of my money is in this Weird Portfolio situation. And with that, it's nice because it's more mechanical. I can just take, for instance, every time you get paid, it's going into the Weird Portfolio and I'm expanding that. And I can just buy systematically whatever ETFs are light every 2 weeks. And both portfolios help me in different ways. So the stock picking portfolio really gives me a way to scratch the itch so I don't screw around with the Weird Portfolio and change the allocations based on what I'm thinking. And then the Weird Portfolio kind of gives me confidence to take risks with my stock picking strategy, where it's like, oh, well, I have this money to the side that is like my fortress of solitude that is safe. And that gives me some bandwidth to go out and really try to pick stocks and try to learn about them and try to learn about the market.
That completely makes sense. Let's get more into the Weird Portfolio, how you break it down. There's certain percentages you have, and I want to get into that a little bit and why you chose those specific asset classes.
Sure. So the Weird Portfolio is 20% US small cap value, 20% international small caps, 20% real estate, 20% long-term treasuries, and 20% gold. So the idea there is basically taking Harry Brown's concepts, like I discussed earlier, increasing that stock allocation, making it globally diversified, pivoting that to value, having some gold in there. And the gold is really there for inflationary environments or currency crises or things like that. The long-term treasuries are there for recessions and depressions because during recessions and depressions, the Fed tends to cut interest rates and For instance, in 2008, long-term treasuries were up 20% while the market was down 37%. And my thinking there was I knew that small cap value and value investing in general helps to avoid major bubbles. It tends to deliver a more consistent rate of return over the long run. But at the same time, it's not immune to recessions and crises and things like that. And having been so deep in the macro weeds when I was younger, I think about that stuff way too much, more than I should. So I wanted some protections there. And the key protections in that portfolio are the long-term treasuries, which, like I said, would perform well in an environment like 2008 or the early 1930s. And then gold also helps. And gold is there kind of like a safe haven asset if things really go to hell. But it also tends to perform well during long inflationary environments. It doesn't have an exact like tick for tick tracking of the CPI if anything's going on like that. But in environments like the 1970s, it did pretty well. And it's actually done okay since 2019-ish, since we've had a bad inflationary situation in the United States. And then it's also there as just kind of like a safe haven asset if everything else, like if, for instance, say the US Treasury defaulted. Well, I'm pretty sure my stocks would get annihilated, my treasuries would get annihilated, but gold would probably still be worth something, and I would still be alive. I'd still be in the game, so to speak.
And gold, you mentioned Harry Browne. It's also an aspect of Ray Dalio's portfolio, isn't it?
Yeah, so Ray Dalio, he has his own version of kind of a risk parity style portfolio like this that he outlined to Tony Robbins in a book, Money Mastered the Game. And his version is the all seasons portfolio. That portfolio is, I had issues with both approaches, with Harry Browne's approach and with his approach. I thought that Ray Dalio's portfolio was way too heavy in the long-term treasury bonds. I think like 40% of the portfolio is in there. I didn't think Harry Browne had enough in stocks, so I kind of settled on my own interpretation of it.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
And you've chosen small cap value both in the US and internationally, right?
Yeah, I thought global diversification was very important. I didn't want to have a lot of home country bias. I'm definitely in like the kind of Jack Bogle mindset where, and this is ironic because Jack Bogle was only a US investor, but that said, his whole philosophy, don't buy, the needle, buy the haystack, and just everything's going to work out if you just own. So I think the same logic works for countries as it does for companies. So you don't know which company is necessarily going to outperform, so you own all of them in an index fund. For a global investor, you really don't know which country is going to perform the best. It's often the United States, but it's not always the United States. So I wanted some global diversification there. And then with the pivot to value, that's really about avoiding major bubbles. So small cap value, while it draws down in a nasty way during the initial kind of bear market, it can still deliver a decent rate of return over, say, like a decade. Because it's kind of more of like grinding out a return. You're selling companies that are depressed. You're selling them when they're stronger. You're collecting dividends across the way. So it tends to deliver a kind of more smooth rate of return than the boom and bust that you see in like large cap growth. And you saw this in places like Japan after the Japanese bubble imploded. If you were a small cap value investor, it hurt. You didn't do great, but you were way better off in kind of a systematic value strategy than you were just buying like large cap stocks.
So are you also, did you say like 20% of that is in real estate? Did I hear that correctly?
REITs, yeah, specifically REITs. And that's also about inflation protection. So that's more about like real estate values at the very least should increase with replacement costs over time. REITs can collect rents from whatever industry they're in, whether it's an office REIT or whether it's a residential REIT, and rents should increase over time with inflation. If you plug it into a backtest, REITs tend to just perform like small cap value. But I thought it was important to have a very specific allocation to that to try to have an added layer of inflation protection in there.
Outside of this, the weird portfolio and your individual stock picking, is there any other investments that you do, or do you just primarily focus on this?
That's it. So I have the weird portfolio, which is my main asset allocation strategy. And then I have cash, which I keep in T-bills and a high yield savings account, which is my emergency fund. And then I have my stock picking, which is my real passion.
Your love, yeah. And you analyze a company a week, right? And write up a report on on your findings. Is that right? Like looking at 10Ks?
Yeah, that's right. And that was really inspired by Warren Buffett. So Warren Buffett, he said, if I were you, I forget who he was talking to, but he was talking to someone. If I were you, learn about every business in America. He said, that's how you should start investing. And they said, well, there's a lot of companies. And he said, we'll start with the A's. So that was Warren Buffett's advice. So I really took that to heart. And I said, well, if I want to really perform well as a stock picker, that's the direction I should take. I should really stop trying to, perfect a back test. And I should really focus more on, and then trying to figure out what's happening with macro. And I should really apply that. I should really start learning about businesses consistently. And then the nice thing about that Substack is it forces me to do that. Every week I need to get out an article. And whether I feel like it or not, I spend a week researching that company, learning about it. And basically what I'm trying to determine, first of all, is this a wonderful company? Is this actually a company with a moat that I think can sustain high returns on invested capital? And I learn about them. And the nice thing about that is, in the past, when I was more of a deep value kind of investor, during a big crash, the screens would all change and I'd have to start from scratch and here's 20 stocks in a screen and I have to research all of them. And I realized that was very limited because, first of all, that crash could end very quickly. By the time you're done all your research, you could have missed out on all the opportunity. So I wanted to say, I want a watch list of companies I like. And they may not be an attractive price right now, but you know what? I'm going to understand them. And if they ever are available at an attractive price, I'm going to buy them. And that's been a great way of going about this. And I've also learned so much just by going through a company every single week and digging into it and trying to figure out the economics of it. I'm just learning so much about all of those businesses and just about the world in general by going through that practice every single week and doing that.
Yeah, it's such a great practice, I think. I remember listening to a talk that Li Lu gave, and it was, I think, at Columbia to some students, and he recommended that they get Value Line and go, same thing, go through these, start at A, or I think it started at 1, there's thousands of companies listed in Value Line and go through all of them. And he did. I think he actually did do that practice. Buffett probably did. Is Value Line something that you utilize?
I've checked it out before. It's not the key thing that I use. The main resources I use right now, I use quickfs.net a lot. That's a great website where you can download over 20 years worth of financials, export it to Excel, and then you can go through and that really tells you a lot about the company. And then I will go into the public filings and then I start there, check out the economics. Is there something about this that interests me? Does this look like it's possibly an interesting opportunity? And then I go into the SEC filings and I try to understand them. And I try to find out, how does this business make money? Is there some kind of secret sauce that they have going on that is a source of moat that allows them to earn these high returns? And then the last piece is valuation, which is always in a state of flux. Often when I go through these companies, if it is a good company, it's usually not at a good price. And then I'll add it to a watch list and move on. In a lot of situations, I thought when I was looking at the company, there's no way this is ever going to get cheap. And then it happens sometimes. It happened to me with Meta. I, looked at Meta a long time ago and I said, well, this will never be in the value bucket. And then within a year it was. So yeah, it's a great exercise to go through and learn about these companies. And pretty much all of them are at some point are going to be available at an attractive price.
What else is in your tech stack or your toolbox that you're using to do your analysis? Is it pretty straightforward? I wasn't familiar with the website that you mentioned with all the historical financial data, but tell me more about your tech stack.
Yeah, it's not that sophisticated. It's quickfs.net. That's a great website. I mean, it's not, my methods aren't sophisticated. Quickfs.net is a sophisticated tool. But yeah, you can go in there, you can quickly bring up any company. And if you pay, you can download all of these financials. So I don't have any affiliation with quickfs.net. I just like the tool. But yeah, I download it and you can look at 20 years worth of financials. In terms of companies to pick, I tend to go through a lot of different sources to just kind of get ideas for companies I should look at. I look at a lot of big investor holdings. So an investor I respect is Terry Smith, for instance. I'll look through his holdings. He pays higher prices than I would ever pay, but he has a very good eye for quality. So I'll go through his holdings. I go through a lot of ETF holdings. I mentioned Toby Carlisle. I look at his ZIG ETF. I see what he's up to. I look at QVal. That's Wes Gray's ETF that's based on Toby's work. I'll look at some quality ETFs like QAL. That's an iShares product. I'll look at that. The Wellesley Fund, they have a lot of very interesting like dividend paying companies that I'll take a look at. And then, a lot of major sourcing of ideas is kind of like just driving around and looking at things. Like I stumbled into a Tractor Supply and I'm like, what's this place like? And I'm long Tractor Supply now. But just kind of saying like, hey, that parking lot looks full. I'm going to check that out. I do less of the mechanical screening like I used to, like run very specific screens and restrict my universe to that. But now I'll look at anything. I just want to learn. I'll learn about any business. And if it's not at a great price right now, okay, I'll move on to the next one and keep an eye on it. And someday it will be at an attractive value.
Yeah, I like the cloning idea. You mentioned Terry Smith and just looking at investors that you admire and maybe copying them to some degree. There's a great, have you ever been on Dataroma? I think it's called Dataroma, and it shows like the holdings of all the top value investors. Have you ever come across that website?
Yeah, I use that. And yeah, that's where I use to kind of see what Terry Smith is up to. You can see what Pat Dorsey is up to. You can see, any big investor, Monish Pabrai, anyone you can think of, you can go on there and you can see what they're up to. And that's always a nice thing to look at.
Yeah, it's great. It's a little delayed because, it's a quarter late or something like that. But it's such a great source of information, I think.
Yeah, absolutely. I love going on there and seeing what a lot of big investors are up to. I would say to that, though, don't simply follow an investor into an idea. Definitely do your own work. And it's not just about like maybe they've made a bad investment. That's possible. But the key thing is like you need to develop your own conviction about things. Like once something goes wrong, if you just copied an investor, you're not going to be able to stick to it. You're not going to be able to hold it. You need to have some conviction yourself and have some understanding of the business you're buying rather than just follow an investor into it. With that said, great way for idea generation, for companies to look at, for companies to research. It's a great starting point, I think.
And I like the idea of just driving around. That's kind of a Peter Lynch idea, right? Like look around you, like what businesses are doing well. You keep your eyes and ears open and you'll be able to figure it out.
Yeah, totally. And I've gone through an experience with Peter Lynch's ideas where I've looked at that in the past, like, oh, well, that's naive. Like, just buy what you know. That's ridiculous. But then thinking about it, I'm like, if I just bought like stuff I liked, like Domino's and Home Depot and Amazon and stuff like that, I probably would be much more wealthy if I went back and then all the other weird things I bought, like if I just did stuff like that. So yeah, trust your own judgment. If you see a business you like, that's a great starting point. I'm not saying just buy stuff you like. Neither does Peter Lynch. He advocates you do research beyond that, but it's a good starting point. Like if you're into something or, someone in your family is into something, you see them going to a specific store or website all the time, it might be worth looking into it and seeing what's going on there.
There was a tweet that you had recently and you asked like, what's the most overrated investment book? I wanted to hear what your findings were. What were some of the things what you think, what some of the, your followers thought?
Oh, that's a controversial question. I think there's a lot of people kind of trolling and saying The Intelligent Investor by Ben Graham. I disagree with that. I do agree with them in the sense that it is a very dense book and it is a bad place to get started. I think a much better starting point for an investor would be something like The Little Book That Beats the Market by Joel Greenblatt, which is extremely accessible. You can sit down and read that in like an afternoon. That's a great starting point to kind of learn the basic principles of value investing. So yeah, some people said that. They said Ben Graham's work. Like I said, I disagree with that, but I understand what they're saying there. Margin of Safety came up a few times by Seth Klarman. I like Margin of Safety. I think it's fine. I think it's a decent book. I wouldn't pay $1,000 for it, but
yeah, I was going to say it's like $1,000 book, at least like I looked it up on Amazon recently. I was like, whoa, I don't think I'm going to be buying that anytime soon.
Yeah, I think that the limited supply of it has kind of increased its reputation, maybe beyond where it's deserved, but I still think it's a pretty good book. I don't have any major issues with it. They mentioned Principles by Ray Dalio, which I thought it was a good one. You read about these. He's written all about all of these principles he has, and there was a book that just came out, The Fund, which is all about Bridgewater and a lot of things, what that's actually like in practice, and most people can't really handle it, like the radical transparency and all that. And I don't know if it's really a great way to run a business, to have all of that radical transparency where people are sharing brutal feedback with each other. And so, yeah, I thought that kind of ranked highly up there. But yeah, that was a fun little tweet.
Yeah, that is fun. I also wanted to hear a little bit about your podcast that you've been doing. Talk to me about some of the guests that you've brought on, and just like, have any of them, I don't know, changed your thought process at all? Or is it not an echo chamber, but like, are you bringing on guests that will challenge your own thinking at all?
Oh, yeah. I have people from all kinds of different persuasions and stock strategies. Yeah, like I'll talk to, like I mentioned, I don't include macro in my process, but I talk to a lot of people about macro. And I'm always interested to hear from successful macro investors and hear what they're doing, hear their perspective on things. Yeah, and I have people from all kinds of different, persuasions. So I've had JL Collins on there. He's a 100% stock indexing investor. That was a great interview. I don't invest in 100% stocks, but I think there's a lot you can learn from him and a lot from that strategy. And that was an excellent interview.
His book is what? The Simple Path to Wealth?
The Simple Path to Wealth. And I'd say if you are starting out and you just want to learn the basics of investing, buy that book, follow the plan, and it's probably going to work out over the long run. So that's a great book. I have macro guys, like I had Citrini on. That was a great conversation. We talked about GLP-1s. We talked about artificial intelligence. I have people that are like more of a Buffett persuasion. I've had them on, like The Science of Hitting. He was a great interview. I talked to him about a lot of different things. I've talked to Toby Carlisle. I've talked to Lawrence Hamtill. He has a very interesting perspective. It's very oriented towards like industries and sectors, and he's interested in a lot of very cool businesses. I've had very deep value guys on, like Evan Blecker. He does exclusively net nets. So I had him on the podcast, and that was a great interview. I've had some long short guys, like I don't short stocks, but I've had, like, for instance, George Levatas from Upslip Capital. That was a very interesting interview. But yeah, overall, it's just a cool opportunity to have really interesting conversations with investors that I respect. And they're from all kinds of different persuasions and ideas. And yeah, I learned something new from all of them. And they're really cool conversations to have.
What about, you're into the small cap stuff. What about Ian Castle? He's more like micro stuff, micro cap. But like, have you ever had him on?
I'm trying to get him on. I've approached him a couple of times. He's been busy, but I'm sure he'll come on eventually. But yeah, I love Ian Castle. He's a really entertaining guy.
He'd be a good one. I want to touch a little bit on movies. I know you're like a movie guy, and I am too. So I wanted to hear some of like your top money, investing movies that you love, like something you'd watch year after year.
Investing movies. I mean, you got to go with Trading Places, right? That's a fantastic movie. Hilarious. Eddie Murphy in his prime. That's an amazing film to watch. Another one I like is Other People's Money. That's a pretty funny one with Danny DeVito. That's a very good movie. He's a corporate raider, and he buys like it actually, the company he's buying sounds like Berkshire Hathaway. Like it's a New England, like they do wire and cable, New England wire and cable. They're getting destroyed competitively. It's like a dying business, and he wants to go in and liquidate it. And what I really like about that movie, so there's Wall Street, which I feel like is almost like it's a cool movie, but it's almost like only giving you one side of the argument, like a very Marxist side of the argument, like capitalism is evil and these guys are terrible. Other People's Money gives you the other side of the argument for the corporate raider. So he's like, hey, this company sucks. It's bleeding money. Why don't we just end this enterprise? And then he actually gives a great speech at the end of the movie where they're meeting with the shareholders trying to decide whether or not to liquidate the company. Like they're going to elect his board and liquidate the company. And yeah, Gregory Peck is the CEO of the company. He gives this very inspirational Gregory Peck style speech of like why this needs to be saved and how it's about more than the company. It's about saving America and all this cool stuff. At any other movie, they would just end it there and he's right. And the corporate raider is wrong. But they actually have Danny DeVito come up and give the other side of the argument. And it's compelling. It's like, why are we keeping this thing in business when it's not making any money for anybody? Take the money, invest it in something with a future rather than trying to keep this thing that's already dead alive.
I'll have to check it out. Yeah, I've never seen it. I mean, I've heard of it, but I've never sat down and taken the time to watch it.
Yeah, it's a good one. And then there's The Gambler. That's a good movie with Mark Wahlberg. Has the famous "F-U money" speech in it from John Goodman. That's a great movie. Yeah, I like that one. Recently, I rewatched The Color of Money. That's a good money movie, more of a gambling movie, but that's about...
Is that Paul Newman?
Yeah, Paul Newman and Tom Cruise. They're pool hustlers. That's a good film. But yeah, those are some good money movies, I think.
I want to talk a little bit about like investing love stories. Is there anything right now in your investment that you're really particularly fond of that holds a special place in your heart? You love checking the price action on it and just following it. And do you have anything like that right now?
Yeah, I'm really fun. I invest in Taiwan Semiconductor. So I picked that up in December 2022. It was at a P of 12. The expectation was we were at a bad point in the semiconductor cycle. It's kind of been perpetually cheap since then because everyone's worried about an invasion from China. My attitude is that if China invades Taiwan, your portfolio doesn't matter that much because we're in World War III. It's kind of my thinking there. But yeah, great company. They manufacture the chips for companies like NVIDIA and Apple. They're really like the engine of everything that we're seeing right now with AI is really made possible by TSM's manufacturing methods. So, and it's not as cheap as when I bought it. Like right now, I think it's around 18 EV bit, something like that. But it's a fantastic business and I like owning it and I like following it.
I want to actually ask you, with all these podcast guests that you're having on, do you fall prey to like kind of shiny object syndrome where they're talking about ideas like, and you're influenced by them and you're changing your own strategy? Do you have flexibility there? Are you pretty, I want to hear about that a little.
I'm pretty set in my ways. So I don't really have that syndrome. But I do like talking to people and learning about what they're doing. But no, I haven't changed really any of my investing practices. When I talk to stock pickers, I can get some good leads there. Like I'll have a stock picker on and they'll mention a company I've never heard of. Like George Levatas, he tipped me off to Ball Corp. That was kind of an interesting one that I looked into.
Ball Corp, is that what do they do?
They make aluminum cans for like Bud and Coke and Pepsi. So, and that's a pretty fantastic business. I don't think when I looked into it, I didn't think it was necessarily at the right price right now, but I think it's a great enterprise. It's got a great moat. Often they have their manufacturing plants set up right next to like the brewers. So I think it's a great little moaty business.
I wanted to hear like if there's like a younger listener that's listening right now, what would you tell yourself, or what would you have done differently looking back on things in your own investment journey and process?
Sure. So, I mean, I'd say if you're younger, you want to really focus more on your career and your personal finances than necessarily like stock picking or that kind of thing. So, this is a Harry Brown thing. He says that your career is your most important source of your wealth, and he's right. You want to really focus as much as possible on your career in those early stages so you can get yourself to a good income in the future. You don't necessarily want to spend all of your time buried in 10Ks and then neglecting your actual job. You want to really focus on advancing your career because that's where a bulk of your capital is going to come from. It's from saving towards your career. I'd also say you want to really focus on personal finance. Like I mentioned, I kind of had to go back to basics. Like I was a finance guy in college. I had learned all this stuff about the stock market, but I found myself in a bunch of debt. And I think if you talk to a lot of people, like even people in the financial industry, they may not admit to it, but there's a lot of them that are in tons of debt and are in atrocious shape with their personal finances. So I'd say the key thing is to establish those habits early on where you're doing things like avoiding bad debt. You are saving a fixed percentage of your income. You're automating your investments. You're very conscious about your spending. You're just not going out there and mindlessly spending money. You want to establish those good personal finance habits early on. I'd also advise that if you do get into stock picking and that type of thing, to really write down and keep an investment journal. So you don't have to necessarily do it publicly like I do on a blog, but if you just keep an investing journal, that will really help you out later on. So when you ultimately go ahead and sell it and say the investment didn't work out, you can say like, well, what did I think 2 years ago about that? Or even what did you think about like macroeconomic situations? You might say like, oh, I think there's going to be a recession next year and here's why. Write that down in your journal. And I think over time that will start to reveal to you that you're probably wrong about a lot of things because people tend to be very selective about what they remember. They remember the wins and they don't remember the losses. And then from that, you can really learn a lot. So I would just say that's a huge thing. Take rigorous notes on what you're doing and keep a journal and monitor your investments and that type of thing. And then overall, I'd say like at that stage of the game, you're not dealing with enough money where your specific allocations and portfolios matter too much. Like say you've saved up $20,000, you lose 10 grand. If the market crashes 50%, that's painful, but it's not, you have 40 years to continue to make money. And in the long term, that's going to be a drop in the bucket compared to what you're going to have someday if you stick to an investment program.
Yeah, those are all really good pieces of advice. I want to do a quick fire round if you're up for it. Do you have time?
Yeah, sure. Let's do it.
Cool. So the first question I had was, what's been your best investment so far?
My best investment so far. In my current portfolio, it's Meta. I'm up about 125%, something like that on Meta from where I bought it. Yeah, so that was a really good one. That one worked out really well.
So at what point did you buy that? A couple years ago then, or a little after COVID, or when?
I bought it at like the middle of 2022. So I was actually early to it. It kept falling like through December. And, that was a good situation where it was a really good company. And if you looked under the hood and you looked at the actual financials, you saw revenues were growing. If you looked into their investor presentations, you saw that the daily average users were increasing. It was an ideal value situation. It also taught me not to move so quickly. Like I think I was a little bit too eager to buy it. So I bought it, like I said, early, like middle of 2022. I should have probably waited a little bit for more of a blowout, but it still worked out. It still worked out okay.
I want to hear, if you want, your thoughts on Bitcoin. Love it, hate it.
My thoughts on Bitcoin. I'm not really a huge fan of Bitcoin. I mean, from an investment standpoint, my view on it is that there's the risk that the government can make it a zero. That's my main concern with Bitcoin, where I feel like if you read about a lot of the use cases for Bitcoin right now, a lot of people are like, it's used by human traffickers and terrorists, and North Korea has their own mining operations because they're an impoverished society trying to make money in any way. But I'm pretty sure if we go to war with a rogue state or there's a terrorist attack and then they tie the funds back where it was moved via Bitcoin, I could see them ending it. I mean, the US government has already, in the past, they ended private ownership of gold. It was a crime to own gold in the 1930s. And I think if they have the incentives there, they could absolutely do something that could potentially make Bitcoin a zero. So for that reason, I still look at it as a pretty speculative kind of investment. And I'm not really sure if we know what the use cases are for Bitcoin right now. Like, I think that it doesn't really work too well as a medium of exchange, as like a currency, because like I can make a deal with you today to do something in Bitcoin. And well, if I say I'm going to pay you 1 Bitcoin for this task, well, it could rise 100%, it could decline 50%. I know that the proponents of it say that volatility will slow down over time as there's wider adoption, but I don't know. So for that reason, I consider it more of a speculative thing. But that said, I need to get some Bitcoin people on my podcast who can maybe open my mind to that. But that's where I'm at right now.
Yeah, no, thanks for sharing that. I wanted to hear too, like you go back to when you were 18 and somebody gave you Ben Graham's book to your 18-year-old self. What book would you give to somebody that's 18 and just kind of starting to get interested in investing and showing, the sparks of the love of investing?
I would give them The Simple Path to Wealth by J.L. Collins. And I would say this is a great place to start. Like, the place to start is more of on the indexing side of things and keeping things simple. And if you do that, you stick to this, it's going to work out over the long run. And then I would say if you are interested in stock picking and you want to get more into that side of things, I think a good starting point would be The Little Book That Beats the Market by Joel Greenblatt. And then I'd say you should also go in and read a lot of the Buffett letters. Another great Buffett resource is a book called Tap Dancing the Work, which is a collection of like all of his best articles. That would be another place.
Yeah, that's a good one. Do you read many biographies like Snowball or, different biographies on investors that you love?
Oh yeah, I actually just recorded a podcast about the snowball. I just reread it. So myself and the Canadian dividend investor got on and talked about it. But yeah, the snowball is an incredible book.
Yes. Yeah. Alice Schroeder, I think, the author. Yeah, I remember reading it when it first came out. It's dense, but it's so good. It's it's a page turner for sure.
Yeah, a little controversial because Warren Buffett doesn't seem to like it too much because probably a lot of it hit pretty close to home. To his credit, he opened himself up to this biographer and he said, write the least flattering version. And I think that would be a tough thing for anyone to do. Like if someone interviewed everybody in your life and wrote the least flattering version of it, that would probably be a hard thing to read. So I get where he's coming from, but it's a great book.
Yeah, for sure. Value Stock Geek, this has been a lot of fun. I really enjoyed this. Thank you for your time. Before we sign off, is there anything that you wanted to talk about that we didn't get to touch on? And how can people find out more about you, learn about like what you're up to and things like that?
Yeah, so you could check out my Substack. That's where I publish a company write-up every week. I publish a podcast every week. So that's the best place to learn about my content is right there. It's securityanalysis.org. You could go to valuestockgeek.com. That also redirects there. That's really where I've got everything. I've got all of my write-ups, updates on my portfolio, and then all of these podcast conversations that I'm having.
Nice. And then you're fairly active on Twitter as well, right?
Yeah, I stay active on Twitter. The handle's @ValueStockGeek. And yeah, I try to post something at least once a day. So I try to keep up with that. And I meet a lot of cool people on there.
Cool. Yeah, we connected through Twitter. So it's a great tool. I will put all this in the show notes. So all those links will be there and people can find out more about you. But thanks a lot for your time today. This has been a lot of fun.
Yeah, thanks. I enjoyed this as well.
When 2020 happened, just like you did, we had, lots of time on our hands. And I spent a lot of that time studying investing, studying all the usual suspects, Warren Buffett, Charlie Munger, and reading and really going down the rabbit hole of value investing. And I found out I loved it.